Picture this. $4.2 billion in crowd-funded checks flying into early-stage companies, but the official watchdog spreadsheet only sees 2.5 and still calls it a day. So why is the gap bigger than a Michael Jordan free throw line dunk, and what does it mean for you if you're betting your savings, your startup, or your reputation on Regulation CF? I'm your numbers-obsessed narrator, 16-year veteran of the private capital trenches, co-author of that fat 210-page market report circulating on founder Slack channels everywhere. And today I'm handing you the decoder ring the Securities and Exchange Commission forgot to include, because by the end of this deep dive you'll know exactly where the compliance plumbing leaks, why real-time platform telemetry tells a richer story than any annual filing, and how a new breed of Influvestors and Investomers is quietly rewriting the rules of price discovery. Ready to swap stale PDFs for living data streams? Learn a 3-step diagnostic that can spot momentum 48 hours before it shows up in the cap table, and walk away with a checklist you can deploy on your next raise or portfolio pick. Good, strap in because we're sprinting through 3 packed rounds with zero fluff, a dash of sarcasm, and more practical takeaways than a 2-day accelerator bootcamp. Starting right now with the elephant in the boardroom, compliance tracking, or as I call it, the ghost filing fiasco. Imagine you're throwing a wedding and the caterer decides the guest count by reading RSVPs that half the invitees forgot to mail back. That's literally what happens when the SEC leans on Form CU updates to tally capital, because only about 59% of issuers bother filing the midpoint notice and barely 65% file the closing notice on time. So the regulator's median raise numbers are missing thousands of deals and hundreds of millions of dollars. Quick swoosh graphic here showing a bright red 41% data void overlaying the blue compliance bar. Cue cash register ding on the missing dollars. Now, before anyone screams at the screen, yes, the agency staff are hardworking pros, but even they concede in footnote 23 that their sample is non-exhaustive, which is legal speak for our telescope fogged up past Jupiter. And the practical fallout is huge because pundits copy those medians into blog posts and founders benchmark their raise targets against a distorted yardstick. So you might set a ceiling at $500K when peer deals are quietly topping $1.2 million. Solution step 1: tap platform dashboards instead of filings, because marketplaces pull transactional APIs every midnight and thus know precisely how many dollars cleared escrow that day. Step 2: filter for duplicates by issuer CK so you can stitch parallel Reg D or Reg E tranches back to the same financing round. Step 3: compute velocity, not just volume, i.e. dollars per day, because momentum outperforms magnitude as a predictor of ultimate success. Quick example. A brewing startup in Phoenix raised only $430,000 total but logged 75% of that in week 1. Their investor count hit 900 by day 8. And within 18 months they executed a 9-figure strategic exit, whereas a consumer hardware play that limped to $750,000 over 200 days still hasn't shipped V1. Moral: speed whispers truth long. Before dollars shout it. Now drop in a playful sound cue of a car peeling out. Then I ask you, have you ever tried Googling the phrase CF velocity curve? No answers, right? So bookmark that term because by the end of this episode you'll wield it like a lightsaber. Speaking of lightsabers, let's slice into part 2, the living heartbeat data that platforms capture every single second yet rarely publish up front. Investor sentiment traces, geographic heat maps, and micro-cohort retention metrics. First, sentiment. Picture a scrolling ticker of pledge comments, emojis, and share to Twitter events. We pipe that text into a natural language engine and score optimism, curiosity, or skepticism on a 5-point scale. Then lag the curve against daily cash flow. Spoiler: a 10% surge in positive adjectives correlates with a 13% jump in next-day check volume, which is why static filings miss future momentum entirely. Second, maps. Toss out the outdated notion that Silicon Valley hogs the pie. Platform geotags reveal capital flowing through 2,300 unique U.S. cities last year, with Tampa, Boise, and Grand Rapids punching 10 times above per capita GDP in tech hardware pledges. So if you run national ads, you're overspending, whereas a tight geofence campaign around emergent pockets yields 4 times the conversion, proven by our dataset of 51,000 unique investors. Third, retention, also called repeat pledge behavior. And here's where Influvestors and Investomers storm the stage. An Influvestor is a backer who holds equity and simultaneously pushes content to their followers, often for free, which means each pledge carries an embedded media multiplier. We saw a vegan snack brand ignite. A 35-second TikTok review from a shareholder chef with 80,000 followers. That single clip doubled their campaign traffic overnight. Cost zero in paid spend. And ironically, the SEC will never see the kinetic chain because it manifests as social reach, not as a line item on Form C. An Investomer, by contrast, is a repeat buyer of the product who later converts into a shareholder. And our analysis shows that campaigns nurturing Investomers before launch secured 29%. Higher first-week velocity. Bring up an animated grid here. Vertical axis first-week conversion, horizontal axis prior customer count. Dots for each issuer. Watch the northeast quadrant glow. Bottom line, early community equals lower CAC equals higher lifetime value. But again, none of that nuance lives in CU filings, and therefore none of it informs public policy debates about capital access. Now, skeptics will ask, what about fraud? If we trust emojis, are we opening doors to scammers? Answer: fraud thrives on speed plus secrecy plus anonymity. And RegCF offers speed but no secrecy and minimal anonymity. Every issuer discloses officers, every platform escrow holds funds, and every backer leaves a traceable payment rail, which is why documented fraud cases remain microscopic. Yet the regulator's summary barely mentions the deterrent power of transparency loops. Quick analogy. It's like secure email requiring two-factor authentication. The friction is front-loaded. The reward is trust. So when the report lumps legitimate compliance delays with a threat of malfeasance, it unintentionally drags perception down, and legislators follow perception. Hence your call to action later. All right, sprint into part 3, pragmatic blueprint for founders, investors, and yes, policymakers who want to align with the living market, not the frozen snapshot. First pledge for founders: compile your mile marker updates before you launch. Preload them into the platform CMS. And time release at 24-hour intervals because velocity loves consistent storytelling. Think of updates as fireworks. Each burst needs to be brighter than the last and spaced just enough to keep necks tilted skyward. Second, for investors, demand access to raw daily data, not just cumulative totals. And if a portal won't expose that feed, consider it a red flag. Third, for regulators, partner with data aggregators to build a sentiment-adjusted risk dashboard rather than chasing stale filings. Color code issuers by traction rate, overlay social signal volatility, then allocate review resources proportionally. That's how you spot trouble early without throttling honest momentum. Quick mini dialogue. Cameo. Off-screen analyst whispers. But what about resource constraints? Host replies. Reallocate 5 analysts from manually checking signature dates to building Python scrapers. Problem solved. Insert light laugh track. Next we pivot to the multi-billion-dollar implication, because private capital is no longer a sleepy cousin of public markets. Last year RegCF issuers alone raised more than US seed stage VC did in 2004. And with automatic annual cap increases baked into statute, the ceiling could hit $10 billion by 2030. If the gatekeepers mismeasure today, they'll misregulate tomorrow, potentially capping your upside or delaying liquidity events. So the motivational takeaway: refuse to benchmark against half-baked medians. Measure what matters in real time, harness your Influvestors early, convert your Investomers diligently, and wield velocity like a compass. Picture yourself scrolling a live dashboard. You spot pledge speed doubling on day 3. You immediately cue a podcast guest spot, influencer unboxing, and press release by day 6. You cross minimum target and unlock escrow. Weeks later the SEC may still think you're midway because the CU isn't filed. But capital reality ignores bureaucratic lag. Closing obligations. Remember, this is educational, not advisory. Do your own due diligence. But if you crave deeper metrics, grab the open source template linked in the description. Integrate with any major portal via API key. And level up your forecasting right now. Final sound cue, cash register ding morphing into rocket whoosh, and we finish with a simple invitation. Hit subscribe, follow the journey, and let's keep democratizing capital one real-time data point at a time.